Have you ever been, staring at a spreadsheet, trying to make a big decision, maybe launching a new product or deciding whether to shut down a line, and you just felt completely overwhelmed by all the numbers? Like, which of these costs actually matter? Because let's be honest, our financial reports, they're just jam-packed with figures. It's incredibly easy to get bogged down. But what if I told you that actually many of those seemingly critical numbers have absolutely no bearing on the decision you're about to make? What if there was a shortcut, a way to cut through all that noise and focus only on the costs that genuinely impact your choice?
Well, that shortcut is real, and it's all about understanding relevant costs. This deep dive, it's really designed to arm you with a powerful framework to spot these crucial costs, helping you sidestep common pitfalls that trip up even seasoned decision makers. You'll learn to zero in on the information that truly matters, making your financial choices much, much clearer. And our source material, it's packed with practical real-world examples that really illustrate these principles, makes them crystal clear.
Right. So our mission today is to unpack this concept of relevant costs so you can confidently assess pretty much any business decision. It's all about focusing on the future cash flows that are actually changed by your choices. Okay, let's unpack this then. Let's get right to the heart of what a relevant cost really is. So when we talk about a relevant cost, it almost sounds obvious, doesn't it? It's a cost that's relevant to the decision. But you're saying that only a very specific kind of cost truly matters for a decision. What exactly is a relevant cost? And I guess, why isn't every cost we see in our books relevant?
That's the critical distinction, yeah. A relevant cost isn't just any cost. It's a cost that will change as a direct result of your decision. So if you make choice A, this cost happens. If you make choice B, maybe it doesn't, or it changes the amount. And when we talk about a change in cash flow, we mean anything that affects the actual money, moving in or out of the company's bank account. This could be additional payments you'll have to make, or maybe payments you'll save, or even a change in revenue coming in.
Okay, so if I'm understanding this correctly, it's about imagining two different futures, like one where we make the decision, one where we don't, and then seeing how the cash flows literally change between those two scenarios. Is that right?
Precisely. And here's a simple, pretty reliable way to test it. Bank statement test. Just ask, would the amounts on the company's bank statement actually be different because of this decision? If yes, it's relevant. If not, it isn't. Bank's record cash, right? So that's a very reliable indicator. And to your point, it's absolutely crucial to emphasize the focus is always on future cash flows, only future ones that are changed by the decision. What's already happened is, well, quite literally water under the bridge. It's done.
Okay. So we know what relevant costs are. Makes sense. But what about those sneaky costs, the ones that feel super important, that maybe we've been taught to obsess over, but actually have zero impact on our future decision?
Right.
That's where it gets really interesting, isn't it? And kind of counterintuitive.
You've hit on the core challenge there. Let's start with the big one. Sunk costs or committed costs. These are money that's already spent, gone, or money that you're already contracted to spend. Think of it this way. A decision you're making today about some new project has absolutely no effect on that money. It's gone or it's obligated, regardless of what you decide now. For instance, say a company spent, $1 million on market research for a new product last year.
Right.
That money is already spent. It won't come back whether you approve the product now or not. It's sunk.
Yeah.
Similarly, if you have, say, a 2-year lease for a piece of machinery, that lease cost is a committed cost. It wouldn't be relevant to a decision on whether to use that machine on some new project that only lasts for the next month. You're paying the lease cost anyway, you see.
So the market research money is, effectively like water under the bridge, gone forever. You can't unspend it no matter what. That's a tough pill to swallow sometimes, isn't it? Especially when you feel like you've already invested so much.
Absolutely. Then there's the reapportionment of existing fixed costs. This one can be tricky because, internal accounting might split up costs in different ways using different bases, and it might look like costs are changing for a department or product. But if the total fixed costs for the company stay exactly the same, regardless of your decision, then there's no actual change in cash flow caused by that specific decision. It's just moving numbers around on paper, essentially.
Right. Okay.
However, and this is important, additional fixed costs caused directly by a decision are relevant. So if your new project requires you to specifically lease a brand new building, the rent for that new building would definitely be a relevant cost. It's new cash going out.
Right. So don't be fooled by those internal allocations if they don't represent new cash actually leaving the bank. Got it.
Exactly. And finally, depreciation and book values. These are often called notional costs, and they're also not relevant. Depreciation, well, it's simply not a cash flow. It's an accounting entry based on past purchases, sometimes pretty arbitrary depreciation rates. By the same logic, book values are just the result of historical costs and accumulated depreciation. They don't represent a current or future cash flow that changes with your decision today.
Okay, so if those are the numbers that can trick us, what are the true drivers then? What costs do matter and genuinely influence a decision's outcome?
These are the costs and revenues that represent actual future changes in cash flows. First, pretty obviously, increases or decreases in cash flows directly caused by a project are relevant. Imagine you're thinking about discontinuing an old product to make room for a new one. The revenue you lose from the old product, relevant. The costs you save from stopping its production, also relevant.
Makes sense.
And of course, the new product will bring in new revenue and incur new costs. All those changes, whether they're variable costs or changes in total fixed costs, they're all relevant here. Second, and this is a truly crucial concept, you mentioned it earlier, revenues foregone. More commonly known as opportunity costs.
Ah, yes, the invisible cost.
Exactly. It's the value of a benefit you give up when you choose one course of action over another. For instance, if your company decides to keep an existing asset, say a machine to use in manufacturing a new product, instead of selling that asset, then the cash flow you would have received from selling it is an opportunity cost. You've essentially given up that potential cash inflow because of your decision to use the asset differently. It's often the one that bites you if you ignore it.
Yeah, that's the one that always feels like the biggest aha moment for people, I think, because it's not a direct payment, right? It's not on the invoice, but it's real money you're leaving on the table, effectively. It always brings us back to that guiding question, doesn't it? What future cash flows are changed by the decision? If you can answer that, you're probably on the right track. Now, let's move beyond the definitions and really put this theory into practice. Let's look at some illuminating examples. This is where you'll see how these principles help us reliably identify the relevant amounts, even in quite complex scenarios, and where that counterintuitive nature really shines through.
Absolutely. Let's start with the relevant cost of materials. Imagine a company making a new product that requires 3 different materials, A, B, and C. For material A, let's say you need 40 units. You have none in inventory. The current purchase price is $7 per unit. In this case, it's straightforward. You'll have to buy all 40 units. The relevant cost is the direct cash outflow to get them, which is $280. Simple enough.
Yeah, easy start.
Now, material B. This gets a bit trickier. You need 150 units for the project. You happen to have 100 units already in inventory, which you originally purchased for $10 each.
Right.
These 100 units have no other use in the company. They're just sitting there. But, and here's the twist, they could be sold today for $12 per unit if you didn't use them for this new project.
Okay.
So that original $10 purchase price, that's a sunk cost. Forget about it. Completely irrelevant. But if you use these 100 units for the project, you're foregoing the $12 per unit you could have received by selling them. That's an opportunity cost. 100 units times $12, that's $1,200.
So that's part of the relevant cost, even though it's not cash out.
Exactly. It's cash not coming in because of the decision. Then you still need another 50 units, right? And the current purchase price for those is $14 per unit. So the relevant cost for those extra 50 units is a straightforward cash outflow of $700. The total relevant cost for material B is therefore the $1,200 opportunity cost plus the $700 new purchase cost, totaling $1,900.
Wow. Okay, so for material B, it's much less about what we paid for the inventory ages ago and much more about what we give up by using it now. Plus, any new purchases we have to make. That's a subtle but huge difference.
It truly is. Finally, let's look at material C. For this one, you need 120 units, and you have 50 units currently in inventory, which you bought for $20 each.
Okay. Another sunk cost coming.
Well, the $20 is sunk, yes. But here's the kicker. This material is regularly used in your current ongoing manufacturing operations. It's not obsolete stock like material B.
Okay, so it's different.
Very different. It means if you divert these 50 units to the new project, you'll just have to buy 50 units sooner than planned to replenish your inventory for your regular production. So the relevant cost for all 120 units needed, whether they come from the existing stock or a new purchase, is the current purchase price. Let's say that's $22 per unit now.
Not the old $20 cost.
No, the $20 is sunk. The relevant cost reflects the future cash outflow needed to replace or acquire the material today. So you're looking at a relevant cost of 120 units times $22 per unit. That's $2,640.
See how quickly those seemingly simple scenarios can become complex. The key is Always asking about the change in future cash flow. Even if you already have the material, like with C, if using it just means you have to buy it again sooner for something else, that future purchase becomes relevant now.
Precisely. Yeah. Let's move to the relevant cost of labor. Imagine a new project requiring 3 types of labor: unskilled, semi-skilled, and skilled. For unskilled labor, let's say you need 12,000 hours. Your existing staff are fully busy, so you'll have to hire new temporary staff at $8 per hour. This is a clear incremental cash outflow. 12,000 hours times 8. $96,000. That's the relevant cost.
Straightforward enough.
For semi-skilled labor, you need 2,000 hours. Now, it turns out you have 800 hours of idle time among your permanently employed staff. They're already being paid their salary, but just aren't busy for that time.
So using them costs nothing extra.
In terms of additional cash outflow for those 800 hours, no, you're already paying them anyway. So the relevant cost for those 800 hours is 0. However, you still need another 1,200 hours, 2,000 total minus the 800 idle. And those will have to come from temporary staff paid at $14 per hour. So that's an additional wage cost. 1,200 hours times $14, $16,800. That's the relevant cost for the semi-skilled labor.
Okay, 0 for the idle time plus the cost of the temps. Makes sense.
Now, skilled labor. This is often where people stumble. You need 8,000 hours for this project. There's a severe shortage of this skill, both internally and externally. The only way to get these hours is to move skilled employees away from making your existing product X. These skilled workers are paid $15 per hour. And product X, which they won't be making, normally takes 4 hours of their time per unit and generates a contribution of $24 per unit.
Okay, hold on. Product X generates $24 contribution and takes 4 hours. So that's $6 of contribution per hour they generate when making product X. My first thought is, okay, if I move these skilled employees, I'm losing that $6 an hour contribution. Is that the relevant cost here, just the lost contribution?
This is exactly where it gets fascinating and where mistakes are easily made. The relevant cost is not just the contribution you lose from product X. Think about it. You're still paying those skilled employees their $15 per hour wage, even if you move them to the new project, right? You're not saving that wage cost.
Oh, right. They're permanent staff.
Exactly. So that $15 per hour wage continues regardless. That's 8,000 hours times 15, $120,000. That cash is still flowing out. Plus, as you rightly pointed out, you lose the contribution from Product X because they're not making it anymore. Product X contributes $6 per hour. So for 8,000 hours, that's another $48,000 in foregone contribution. That's an opportunity cost.
Wow.
So the total relevant cost for skilled labor is the $120,000 in continued wages plus the $48,000 in lost contribution. That totals $168,000. The $15 an hour wage is still relevant because those labor costs are not saved by redeploying the staff. They are a cost incurred to maintain that workforce. And using them here means you forego the benefit contribution they would have generated elsewhere.
Wow. Okay. That's a brilliant distinction. So it is not just about what you might save, but also what you would have done with those resources and what you still have to pay for them. So like a financial triple threat you have to consider. Very easy to misinterpret that one.
Very easy. Let's move on to relevant cost of machinery. First, let's look at an update versus sell decision. Imagine a company bought a machine years ago for $300,000. Its net book value in the accounts now is $50,000. They have 2 options today. Option 1, spend $100,000 cash to update it. If they do, the updated machine would generate $150,000 in contribution from products over its remaining life. Option 2, just sell the machine now, as is, for $75,000 cash. What should they do, update or sell?
Okay, lots of numbers. My instinct is to ignore the $300 K and the $50 book value based on what you said earlier.
Absolutely correct. The original $300,000 purchase cost is sunk. Gone. Irrelevant. The $50,000 book value and any associated depreciation are not cash flows. Also irrelevant. We only look at the future cash flows that change based on the update versus sell decision. So if they update, what are the relevant cash flows? Well, there's the update cost itself, $100,000. That's a cash outflow. Then there's the $150,000 contribution the updated machine will generate. That's a cash inflow. But there's one more crucial piece.
The opportunity cost. If they update it, they can't sell it now.
Exactly. The opportunity cost of not selling the machine now. That $75,000 cash they could have received from selling it is a foregone cash inflow if they choose to update. So we treat that foregone $75,000 inflow as effectively a $75,000 outflow in this calculation when considering the update option.
Okay, so if we update, net of $200K cost plus $150K contribution, net of $75K opportunity cost.
Correct. Net those out. $150K inflow minus $175K total outflows. You end up with a net cash outflow of $25,000 if you choose to update.
So selling it now for $75K cash is better than updating it and ending up $25K worse off in cash terms. Sell the machine.
Precisely. This really highlights how sunk costs and book values can cloud your judgment and why identifying those opportunity costs is so critical. It also raises that important question. Are we truly factoring in all the alternatives and their real cash impacts?
Definitely. What about a slightly different machinery scenario? Adding a new machine in an existing factory.
Good question. Let's say a business rents a factory for $60,000 per year, but currently only about half the space is actually used. They're considering installing a big new machine in the unused part of the factory. The machine costs $2.1 million up front. It would be depreciated, say, at $200,000 per year for accounting. It's expected to last 10 years and then be sold for $100,000 scrap value. It also needs an extra $5,000 per year for specific insurance just for this machine.
Okay, so what's relevant here? The rent.
The factory rent of $60,000? Nope, not a relevant cost for this decision. Even though you're using more space, the total rent payment isn't changing because you bought this machine. It's a committed cost you're paying anyway.
Right. What about the machine cost?
The cost of the new machine itself, the $2.1 million, absolutely relevant. That's a direct future cash outflow caused by the decision to buy it.
And the depreciation?
$200 a year.
Not relevant. As we said, depreciation is not a cash flow. It's an accounting allocation of the past cost.
Okay. The sale proceeds at the end. $100 to you.
Yes, that is relevant. Yep. It's a future cash inflow expected at the end of the project's life, directly resulting from buying the machine now.
And the insurance. $5 a year.
Also relevant. It's an additional fixed cost, a cash outflow caused directly by the decision to acquire and operate this specific machine.
Got it. So it's all about, did this specific decision cause this future cash flow to happen or change? Exactly. Let's try a further processing decision. A company buys a chemical for, say, $12,000. It processes it, and it splits into two intermediate components, A and B. At this split-off point, component A could be sold immediately for $7,000, and component B could be sold for $4,000. The company also allocates some of the initial $12K costs and other joint processing costs, maybe $6,000 to A and $6,000 to B, for inventory valuation. Now they have the option to process each component further. Processing A further costs an extra $6,000, but then it sells as product A for $12,000. Processing B further costs an extra $8,000, and then it sells as product B for $15,000. Should they process A further? Should they process B further?
Okay, first instinct. Ignore the initial $12K cost and those 6K allocations for this decision.
Perfect. The initial $12,000 chemical cost and those allocated joint costs of $6,000 each are completely irrelevant for the further processing decision itself. They are sunk costs relative to the stage you already incurred them to get to the split-off point. You need to focus only on the incremental revenues and incremental costs for each component if you decide to process it further.
Okay, so for component A, if we process it further, we spend an extra $6,000.
Right. And what's the incremental revenue? It sells for $12,000 instead of the $7,000 it would sell for at split-off.
So the incremental revenue is $5,000, $12K. So
exactly. So for component A, incremental costs $6,000, incremental revenue $5,000.
Not worth it. You lose $1,000 by processing A further.
Correct. Now component B, if we process it further, the incremental cost is $8,000, and the incremental revenue, it sells for $15,000 instead of $4,000.
That's an incremental revenue of $11,000, $15K, $4K.
Right. So for component B, incremental cost $8,000, incremental revenue $11,000.
Definitely worth it. You gain $3,000 by processing B further.
Precisely. So the optimal decision is to sell component A at split off, but process component B further into product B. If we connect this to the bigger picture, this shows how vital it is to focus only on the cash flows related to the next step, the decision right in front of you, not getting bogged down by costs that came before.
Yeah, that's clear. This is particularly illuminating, I think, when considering whether to shut down a production line or a whole division. I can just hear the sound of spreadsheets groaning under the weight of those misallocated fixed costs you mentioned earlier. It's almost like the accounting system itself is trying to trick us into making bad decisions sometimes.
It certainly can feel that way, can't it? Let's take an example. Say a company has two production lines, A and B. The internal management accounts, maybe using floor space or something arbitrary, show line B is losing $4 million, while line A is making a $6 million profit. The total profit looks like $2 million. Total fixed costs for the company are $24 million, and they've been apportioned, let's say, $14 million to B and $10 million to A.
So, based on that report, shutting down line B looks like a no-brainer, right? stop the $4 million loss.
That's a trap. We need more information. Let's say we find out that closing down either line A or line B would actually save 25% of the total fixed costs. Not the apportioned amount, but 25% of the $24 million total.
So closing either line saves $6 million in actual cash outflows on fixed costs.
Exactly. Now we can analyze properly. Let's look at closing line B. If they close line B, they lose its revenue, which is, say, $30 million, but they save its marginal costs, materials, direct labor, etc., which are $20 million, and they save those actual fixed costs of $6 million.
Okay, so lost revenue 30 meters, saved costs 20 meters marginal, plus 6 meters fixed equals 26 meters.
Right, so the net impact on the company's overall profit by closing line B is a loss of $4 million. 30-meter revenue gone, only 26 meters cost saved.
So closing the loss-making line actually makes the company worse off by $4 million.
Wow, exactly. So they shouldn't close line B. What about closing line A, the profitable one? Let's say line A's revenue is $28 million. Its marginal costs are $12 million. Closing it would also save $6 million in fixed costs.
So lose 28 meters revenue, save 12 meters marginal plus 6 meters fixed, equals 18 meters saved costs.
Net impact, a $10 million loss to the company, 28 meters, 18 meters. So definitely don't close line A either.
This is fascinating. The initial fixed cost apportionment was totally misleading. It made line B look terrible and line A look okay, but closing either was a bad idea based on actual cash flows.
Precisely. A better presentation, focusing on contribution, might show line A contributing $16 million, 28-meter revenue, 12 meters marginal cost, and line B contributing $10 million, 30-meter revenue, 20-meter marginal cost, towards the $24 million fixed costs. Total contribution, $26 million. Total fixed cost, $24 million. Overall profit, $2 million. The crucial comparison is, what contribution, cash inflow covering fixed costs, do you lose if you shut the line, versus what actual cash outflow on fixed costs do you save? So what does this all mean? Don't let arbitrary accounting allocations obscure the true cash flow impact. You have to ask, what costs actually disappear if we shut this down?
Great example. Okay, one final one. Make or buy decision. This comes up a lot. Let's say a company makes a product internally. It requires 2 sequential operations, op1, then op2, both done on the same machine, which is currently working at full capacity. There's no spare time. Op1 takes 0.25 machine hours per unit. Op2 takes 0.5 machine hours per unit, so 0.75 hours total per unit. The material cost that they make it is $12 per unit. Now, they find they could buy in components from an external supplier for $15 per unit. If they do this, they only need to perform operation 2 internally, the 0.5-hour step. They skip OP1. The question is, should they continue making the whole thing or buy in the components? Assume the machine running costs per hour are the same regardless of the operation.
Right. First thing, the machine running costs per hour, are they relevant?
You said the machine is fully utilized either way.
Yeah.
Just doing different things. So
Yeah.
no. The total hours run might even decrease slightly if we buy, but the machine is still running full time.
Correct. The machine running costs are likely not relevant here because the machine remains fully utilized. Its total operating cost probably doesn't change significantly just because the mix of operations shifts. No change in cash flow there.
What about the material component cost?
That definitely changes. It goes from $12 per unit if we make up to $15 per unit if we buy in. So that's an extra $3 cost per unit if we buy. Seems relevant.
It is relevant, yes.
Yeah.
An incremental outflow of $3 per unit. So, okay, we're looking at an extra $3 per unit cost if we buy it in. That seems like a bad deal on the surface, doesn't it?
Well,
Where's the potential aha moment here?
this is where it gets truly clever and why just looking at the per unit purchase price difference is dangerous. That additional $3 per unit for buying in is not the whole story, not even close. What's the crucial consequence of only needing to do op2, 0.5 hours, instead of op1 plus op2, 0.75 hours?
We save 0.25 machine hours per unit.
Exactly. And what does that mean if the machine was previously running at full capacity?
It means we now have spare capacity. We can make more units overall.
Bingo. Buying in the components frees up machine time, allowing for a significant increase in production volume. Each unit currently takes 0.75 machine hours. If they buy in components, it only takes 0.5 hours. That means for every, say, 2 units they used to make, taking 1.5 hours, they can now make 3 units, taking 3 by 0.5 equals 1.5 hours. That's a 50% increase in potential output.
Wow, okay.
Let's say current output is 1,000 units. Buying in allows them to potentially make 1,500 units using the same total machine hours. This means potentially an increase in revenue from selling those 500 additional units.
Yeah.
If they sell for, say, $30 each, that's $15,000 in new revenue.
Right.
And what are the incremental costs associated with those extra 500 units? It would be the buy-in cost for all 1,500 units now, $15 each, plus any other variable costs, compared to the material cost, $12 each for 1,000 units plus variable costs. Let's simplify slightly. Let's compare the incremental revenue from the extra 500 units, $15,000, to the incremental cost of producing them by buying in. The extra cost for those 500 units is 500 units, 15 unit equals $7,500, plus the extra $3 per unit on the original 1,000 units, 4 3 equals $3,000.
Total incremental cost is $10,500.
So incremental revenue, $15,000, incremental cost, $10,500.
Exactly. Since the incremental revenue clearly exceeds the incremental cost, it is absolutely worth buying in those components.
Yeah.
It allows you to leverage your bottleneck resource, the machine, to generate significantly more overall contribution. That completely flips the initial view based on just the $3 extra purchase cost. You have to look at the bigger picture, the impact on overall throughput and profit.
Precisely. So winding this all together, when you're looking at pretty much any business decision, always come back to that core question. What future cash flows are changed by this specific decision? That simple question is your most reliable test for identifying the relevant costs and revenues. It applies whether you're looking at a simple material purchase, a complex investment, or a major strategic shift.
And as we've seen through these really diverse examples, from new projects, investments, deciding if a product's viable, setting minimum prices, those make or buy choices, and even critical shutdown decisions, understanding relevant costs is incredibly powerful. It really does provide a clear, actionable lens. Cuts to the noise, cuts through the accounting convention sometimes, and allows you to focus on what genuinely moves the needle in terms of cash. It's about moving past just seeing the numbers that sit there on the page, to seeing the actual money flowing in and out or not flowing because of your choices. We've definitely unpacked a truly vital concept today. Moving past those static numbers to the ones that genuinely drive outcomes for your business decisions, you should now have a much better framework, hopefully, to approach financial choices with a sharper, more focused mind.
Yeah, and maybe a final thought for you to consider. The next time you're faced with a big decision, don't just look at the reported bottom line impact immediately. Ask yourself, what hidden opportunity costs might I be overlooking here? What benefits am I giving up by choosing this path? And conversely, what seemingly fixed costs am I trying to influence through maybe accounting tricks or allocations when they won't actually change my cash position at all?
Great points. Use this thinking in your own context. Challenge the numbers you're given sometimes, and keep digging deeper into the information that truly drives outcomes.